So today we are going to decode the accounting equation and the modern rule of accounting for you. Here we are dedicated to make the subject accounting easier for you, more importantly, interesting for you. So please subscribe to this channel just now if you haven't subscribed yet and hit the bell icon to get prompt notifications. So directly moving ahead to the topic, suppose the sweet shop is a business of Mr. Das. The business sells, as you can see, sweets over here. Now, the business, that is the shop, takes funds, say 10,000 rupees from its owner, Mr. Das. Now, if we can see that in this particular example, two accounts are affected by the shop, that is the cash account, and which is an asset because 10,000 comes into the business, and of course the capital account being a liability since it creates a present obligation on the shop to repay money back to this person sometime in future. We see that the transaction has hit both the capital account and the cash account by an equal amount in the opposite direction. And if we go mathematically and put this in an equation, we find that cash is equals to capital. That is, the left hand side equals to 10,000, the right hand side. Now, if we put this again on a similar example, say this sweet shop takes another loan from a bank which is an outsider, we find that again the two accounts are affected over here, which is the cash account and the bank loan account. The cash account is an asset for the business, whereas the bank loan is a liability for this business. And this transaction hits cash account and the bank loan account equally by 15,000. Now, if this statement is true, the accounting equation B, cash equals to bank loan, that is 15 on the left and 15 on the right. Now, if we put both the transactions together, both the equations together, we get cash equals to capital plus liabilities, which is the bank loan. That is 10,000 plus 15 on the left hand side and 10,000 plus 15 making up 25,000 on the right hand side. Simply put, we can say that assets equals to capital plus liability, and this is famously known as the accounting equation. The accounting equation tells us that any transactions and every transactions would have at least two effects in opposite directions, right? And by tradition, asset is written on the left hand side, also known as the debit side, whereas capital plus liability is written on the right hand side, also known as the credit side. Because remember the other class, debits and credits are nothing but the two opposite sides of anything. Now, as we see, assets are on the debit side, which also gives us an understanding that an increase or an incoming of an asset would be on the left hand side, which is the debit side, and the decrease or the outgoings in assets would be reversed, that is, it would go on the credit side. Similarly, capital and liability are on the credit side by tradition. So an increase or an incoming of a liability would be credited, whereas a decrease or an outgoing of a liability would be reversed, that is debited. Moving ahead, we have learned in my earlier videos that drawing is a reduction in the capital account. That is, with an increase in drawings, capital would reduce. A reduce of capital, we learned just now, is debited. Thus, drawings is debited when it is increased. So this was some basic concepts about the asset, capital, liability and drawings. Moving ahead to income, The business enterprise can also be seen as an agent of the owner who runs the business and earns profits. The profits actually belongs to the owner, and whatever profits the business earns, the business drops it in the capital account since it actually belongs to the owner and thereby increasing its capital. So incomes and gains, that is the revenues that the enterprise earns, increases profits. And simply put, more the income, more would be the profit, and more would be the capital. So we can say incomes and gains increases the capital, and whatever increases capital would be credited. Thus, income is credited. Now, it is evident that income increases profits, whereas expenses would then reduce profits, right? Expenses are the items which reduces profit, which in turn would reduce capital. Thus, anything which reduces the capital is debited. So, expenses are generally debited. So, this gives us to the derivation of the American rule of accounting, which says that the assets, drawings, expenses, and the losses have debit balances. Increase would be debited, and decrease of any of these items would be credited. Similarly, capital, liability, incomes, and gains. The increase of any of these items would be credited because they are on the credit side, whereas a decrease of any of these items, it would be reversed. That means it would leave its place of debit and would go to the debit side to get its reversal. So this was a basic concept about the American rule of accounting, primarily known as the modern rule of accounting. With this, we complete our both the rules, that is the golden rule, that is the traditional, as well as the American, the modern rule. So thank you for watching this video and have a nice day.